Hello and welcome back. Today we're going to continue looking at currency exchange rates, and our mind map is going to cover foreign exchange markets and currency regimes. Now, within this material, there are three broad topics that I want to discuss today. The first has to do with participants in the foreign exchange markets. The second has to do with the instruments commonly utilized for foreign exchange transactions. And finally, we'll look at various exchange rate regimes in countries. The market can be broadly classified into two areas, the sell side and the buy side. On the sell side are the primary dealers in currencies and the originators of forward contracts. These are primarily large multinational banks, also often referred to as the interbank market. The second broad category of participants are referred to as buy side. This consists of many buyers of foreign currencies and forward foreign exchange contracts. The Bank for International Settlements, which is an umbrella organization for the world's central banks, conducted a survey in 2010 which gives a broad indication of the current size and distribution of global foreign exchange market flows. According to this survey, interbank or sell-side flows account for 39% by trade volume, while the flows between the large banks and financial and non-financial customers, or the buy side, accounted for 61% of the total trade volume. Further, the proportion of buy-side flows accounted for by financial customers is much larger than that accounted for by non-financial customers. Financial client flows, which account for 48% by trade volume, exceeded sell-side or interbank trading volume for the first time in 2010. Let's look at the categories contained within the buy side. Real money accounts, which include investment funds managed by insurance companies, pension funds, and other institutional investors, are referred to as real money because they are usually restricted in their use of leverage or derivatives. Leveraged accounts includes hedge funds. Sovereign wealth funds belong to countries with large current account surpluses. Finally, in this category are central banks, which often intervene in foreign exchange markets in order to influence either the level or trend in the domestic exchange rate. Non-financial customers include corporations of all sizes. Next, retail accounts consist of individuals trading for their own accounts as well as small hedge funds and other active traders. Finally, governments often have various kinds of foreign exchange needs. Next, let's turn our attention to the market instruments. Now, although the media generally focuses on the spot market when discussing foreign exchange, the majority of average daily trade volume involves the foreign exchange swap market. And this comprises participants either rolling over or modifying their existing hedging and speculative positions. According to the same market survey we referred to earlier, the 2010 BIS survey, swaps account for about 44% by trade volume and spot transactions about 39%. Finally, let's turn our attention to exchange rate regimes. The IMF categorizes exchange rate regimes into two broad categories: regimes for countries that do not issue their own currencies and those for countries that do issue their own currencies. Let's take a look at each of these in turn. There are two different types of arrangements possible within a country that does not have its own legal tender. The first is known as dollarization, in which the country uses the currency of another nation as its medium of exchange and unit of account. In the second, the country participates in a monetary union whose members share the same legal tender. In either of these cases, the country gives up the ability to conduct its own independent monetary policy. Now, for countries with their own currency, there are 7 different types of regimes that the curriculum refers to. In a currency board system, or CBS, there exists an explicit legislative commitment to exchange domestic currency for a specified foreign currency at a fixed exchange rate. The common example of a currency board system exists in Hong Kong, where Hong Kong dollars may only be issued when they are fully backed by an equivalent amount of US dollars. Now, in this instance, again, the country gives up its independent monetary policy and in fact inherits the inflation rate of the foreign currency. Now, in a conventional fixed peg arrangement, the exchange rate may be pegged to a single currency or to a basket index of the currencies of major trading partners. There is a band of up to plus or minus 1% around the parity level within which the market is allowed to determine the exchange rate. Note that unlike the currency board arrangement, in a conventional fixed peg, the target level of foreign exchange reserves is discretionary. That is, it may have no relationship to the domestic monetary aggregates, that is, the currency issued by the country. In this system, the monetary authority enforces the band thresholds either through direct intervention, that is, buying or selling foreign currencies in the foreign exchange markets, or through indirect intervention via interest rate policy or the regulation of foreign exchange transactions or reducing private sector demand for foreign exchange. The monetary authority in conventional fixed peg arrangements retains more flexibility to conduct an independent monetary policy than with dollarization or a monetary union or a currency board. However, ultimately, it is constrained by the requirements of the peg. A currency peg within a target zone has somewhat wider intervention bands, up to plus or minus 2% around the parity. Now, these wider bands provide the monetary authority with greater scope for discretionary policy. In countries with higher inflation, the crawling peg system allows for adjusting the exchange rate periodically, either via a passive crawling peg or an active crawling peg, in which a series of exchange rate adjustments is announced and implemented over time. Note that an active crawling peg can influence inflation expectations and add some predictability to domestic inflation. Monetary policy in crawling peg systems is restricted in much the same way as with fixed peg arrangements. The next category is referred to as crawling bands, in which the bands that identify permissible exchange rates is increased over time. This approach is used to transition from a fixed peg to a floating rate in cases where the monetary authority's lack of credibility makes an immediate change to the floating rate system impractical. A managed floating exchange rate is where the monetary authority attempts to influence the exchange rate in response to specific macro indicators such as balance of payments, inflation rates, or employment. Note that in managed floating exchange rate systems, the intervention has no specific target exchange rate or predetermined exchange rate path. Also note that such monetary authority action may induce trading partners to respond in ways that reduce stability. Finally, when a currency is independently floating, markets determine the exchange rate. Intervention by monetary authorities is used only to slow the rate of change or to reduce short-term fluctuations and not to keep exchange rates at a certain target level. Well, that brings us to the end of the material I wanted to cover today. Please do leave me feedback in case you have suggestions for improvement or areas that you'd like me to cover. Good luck as always. I'll be back soon with more videos.